Most people calculate their tax burden based on an annual income tax return. But hidden taxes, inflation, currency debasement, and regulatory compliance extract an additional 30 to 50% of your real wealth every year. Monetary debasement is the most invisible tax. When central banks expand money supply without corresponding economic growth, the purchasing power of the entire stock declines. From 2020 to 2024, the U.S. expanded its monetary supply by roughly 40%. This expansion redistributed existing wealth from savers to asset holders and borrowers without creating new economic value. This graph illustrates the real return trap. If you hold currency in an account earning 0.5%, while money supply expands 5% annually, you experience a negative 4.5% real return. Over a decade, that is a 40% erosion of purchasing power. Cash is a melting ice cube. Institutional operators immediately melt that currency into productive hard assets before the erosion begins. The inflation tax on consumption hits essential categories hardest. While headline inflation remains low, food costs climbed 18% and energy costs rose 23%. The wealthy acquire real estate to capture arbitrage. As nominal rents rise, debt service stays fixed. The real value of debt declines while income rises. Compare this to the opportunity cost tax. Idle savings flatlines, while deployed capital compounds exponentially over 30 years. Holding idle capital is an active million-dollar tax on inaction. In an inflationary environment, traditional saving is a guaranteed path to impoverishment. High net worth operators ruthlessly minimize the financial service fee tax. A 1% advisor fee on $1 million portfolio seems trivial, but it results in over $300,000 in lost compounding over 30 years. Investors also leak 10 to 15% of their annual returns to the tax inefficiency tax. Holding concentrated positions in taxable accounts without strategic harvesting or fund placement triggers unnecessary taxation that erodes terminal wealth. Then there is the lifestyle inflation tax. As salaries increase, housing and vehicle spending often rise in parallel. This automatic escalation captures your earning power into higher fixed overhead, locking you into perpetual employment. The retail financial industry and consumer habits act as debris in the machine, structurally designed to siphon off your yield before it compounds. The wealthy view traditional education as the credential tax. They prioritize just-in-time skill acquisition that directly impacts earning power over 4-year degrees that offer a declining return in a shifting economy. Delaying a wealth-building initiative triggers the delayed execution tax. Every year you wait to launch a venture or invest capital, you forfeit the exponential leverage created by the final years of compounding. Retail investors often pay the information asymmetry tax. By the time market data hits mainstream media, institutional players have already moved. The wealthy pay for proprietary research and private networks. This information advantage allows them to allocate capital months before retail investors catch the signal. Wealth building is a function of timing. You must be structurally positioned to execute on information before the masses. Psychological liability tax is the cost of poor emotional discipline. During corrections, retail investors sell at the exact bottom, locking in permanent losses. The wealthy remove emotion from capital allocation, using automated investment rules to maintain discipline. You pay the concentration risk tax when your entire net worth is tied to your job. If your employer or industry collapses, your income and employment value disappear simultaneously. Finally, the network poverty tax stems from social circles consisting entirely of consumers. This cuts off access to the deal flow and strategic partnerships that multiply wealth. Mastering external economic forces is meaningless if you fail to control your internal emotional discipline and social proximity. The largest drain of all is the inaction tax. It is the mathematical difference between the net worth you could have built and the net worth you will actually accumulate by doing nothing. Your choice today is binary. You can continue accepting these 15 hidden taxes as inevitable, or you can implement the structural defenses that neutralize them. Subscribe to the Money Formula right now to master institutional strategies. Identify which hidden tax has cost you the most in the comments and commit to fixing it in the next 30 days. Stop funding other people's wealth and start building your own.